Hello and welcome to Finance by AI, a channel dedicated to creating finance content with the support of artificial intelligence. In this video, we will be breaking down investment vehicles into a tier list based on their risk to return prospects and other similar metrics. Here you can see the tier list that we have created. At the top of the tier list, we will have what is labeled basically gambling, which, as you can tell by the name, means that these types of investments are incredibly risky with chances of incredible returns which are basically the same as spinning a roulette wheel. At the bottom we have what is labeled loses to inflation, which basically are investments that are almost guaranteed returns but will probably give you such small returns that your buying power stays the same most of the time. Everything else in the middle is basically self-explanatory, so let's get on with the video. The first investment instrument we have here is the good old index fund investing. Index funds are diversified investments where the fund which is traded on an exchange tracks an index composition. An example would be SPY, which tracks the S&P 500 index, an index comprising of the top 500 United States listed companies. On average, the index returns about 8% to 10%, but may vary depending on the index chosen. It's a good balance between risk and return, and everybody should be invested in an index fund if they are not doing so already. It will be put in the good balance of risk and return category. Next, we look at good old hard cash. Great as a medium of exchange, but not so good as a form of investment. Cash typically loses 2% of its value every year due to an economic force known as inflation. Investing has the typical end goal of beating inflation, so we can easily put this in the lowest tier. Moving on to more exciting investments, we have options trading next. Here we will focus on more logical options trading with actual fundamental probabilities of turning a profit. Options are basically contracts which give the buyer the right but not the obligation to buy or sell a stock at a certain price at a certain date. Most of the time these are used as bets by traders on the move of stock prices, but can also be used as hedges or instruments to lower risk. Leaps or long-term equity anticipation securities are options with longer expiration dates, normally at least a year out. These are more logical investments as they give a longer time horizon and thus higher probability of the user being right about their predictions. Still, it is incredibly risky as you must be right not only about the direction of the stock, but also the timing and percentage change, and thus will be put as borderline gambling. Hedge funds and other sophisticated investors use these options as a way to manage risk, though most retail investors enjoy speculating using this instrument. Next, we look at treasury bills. These are basically debt obligations by the government where you can buy these bills from the government with expiration dates of less than 1 year. These are very safe investments as they are backed by the United States Treasury and their interest tends to be rather low compared to other investments. We will be putting these investments above cash. Moving on, we look at large cap cryptocurrencies next. These refer to Bitcoin and Ethereum, which are the largest cryptocurrencies right now. Investing in crypto in general always comes with high risk. However, buying large cap cryptocurrencies are less risky than smaller coins as they have a proven track record and even now have exchange-traded funds trading Bitcoin. Though they still experience changes in value easily exceeding 10% and will thus be labeled as risky but still manageable. Cryptocurrencies in general have started to gain traction and have been accepted by the investment community as a form of legitimate investment. Next, we move on to real estate. Real estate is a common form of investment as everybody needs a place to live and will look to purchase a home for themselves in the future. This normally includes taking out a mortgage and then paying that loan for a long period of time. The housing market globally rises higher than inflation and thus will be under good balance between risk and return. Though property prices changes mostly depends on the location of where it is built. Now we have the last two investments which are incredibly risky. First, we have meme coins. These are small-cap cryptocurrencies that can experience insane moves both up and down. No one knows which coins will be the next big thing, and thus this will fall under basically gambling, as meme coins investors are always gambling on which next coin will catch the next hype phase. Lastly, we have the Wall Street Bet's favorite, which are short-term options or FDs. These are basically options with a very short time frame, normally not more than a few days. These are incredibly risky as there is a limited time frame for the stock to move in the direction you predicted, and most of the time these options will expire worthless and result in a total loss. Thus, this will also be put in the basically gambling category. That concludes the end of the video. If you guys do like this type of content, don't forget to like, share, and subscribe as it helps the channel tremendously, and see you next time.